In this video, I'm going to show you how to easily invest in ETFs in Australia. I'll also cover all the important things you need to know before investing in ETFs, some advantages and disadvantages of ETFs, and the best investing strategy to use to maximize your returns and reduce risk. And at the end of the video, I'll show you a live demonstration on how to buy your first ETF using an online broker. So if you're interested, let's get straight into it. So firstly, what exactly is an ETF? Well, ETF stands for Exchange Traded Funds. Simply put, an ETF is like a basket that holds a collection of different investments such as stocks, bonds, and other assets. And in this particular video, we are mainly talking about ETFs that contain stocks. So it allows you to own a small piece of that basket by buying shares of the ETF. For example, say you are interested in buying some shares in Apple, Amazon, Tesla, Google, and Facebook, but you don't have enough money to afford them all. So instead of purchasing each of these stocks individually, you can buy shares of an ETF, which represents a portion of the entire collection of investments held by that ETF. Buying just one share of this ETF means you become a part owner of these companies within the basket. So in this example, you could consider NDQ, which is the BetaShares Nasdaq 100 ETF, which tracks the top 100 largest tech companies in the US stock market, which includes the stocks I just mentioned earlier. And if you're only interested in the Australian stock market, you could look at something like VAS, which is an ETF by Vanguard that allows you to invest in the top 300 Australian companies. Or say you're interested in investing in Asia, you could check out something like VAE or Asia, which groups together all the biggest Asian companies into one ETF. You can even invest in properties without having to physically manage one through a property ETF like VAP. You simply just invest into it, pay a low management fee, and they will look after everything for you. And quick disclaimer, the ETFs I just mentioned are not buy recommendations. I'm just using them as an example, so it gives you a good starting point to do your own research. Also, I am not a financial advisor, and this video is for entertainment purposes only. Please go see a professional if you would like financial advice. With that being said, let's move on. Now there are two types of ETFs, active and passive. Let's start with active. An active ETF, as the name suggests, employs an active management strategy. Unlike passive ETFs that aim to replicate an index, active ETFs have a portfolio manager or team to make investment decisions to outperform the market or achieve specific investment objectives. The goal of active management is to generate higher returns than the benchmark index. Now all this sounds well and good, but historically speaking, about 90% of active managers fail to beat the market in the long term. And due to the active nature, with more work involved, active ETFs usually charge a higher fee than passive ETFs. So historically speaking, that is a double whammy. By investing into active ETFs, not only is there a higher chance of you underperforming the market, you are almost guaranteed to pay more fees during the life of your investment. So there's got to be a better option, right? Well, that's where passive ETFs come in. A passive ETF, also known as an index ETF, tries to replicate the performance of a specific market index. The main goal is to match the returns of the underlying index as closely as possible. For example, VAS is a passive ETF because it tracks the S&P ASX 300 index. And this particular index tracks the top 300 Australian companies listed on the ASX. This ETF requires very little work because it just follows the exact moves of the index, so it's passively managed. And therefore, their management fees are usually quite low. Passive ETFs typically follow a buy and hold strategy, meaning they aim to hold the stocks in the index for the long term without actively buying or selling based on market conditions. And this is a strategy that is recommended to most people by Warren Buffett himself. In fact, on multiple occasions, he has advised most investors to stick to low-cost index funds as a long-term investment because it generally beats most of the more expensive actively managed funds. And for these reasons, passive ETFs are more popular than active ETFs. And when people talk about ETFs in general, they are usually referring to passive ETFs. And when people say invest in index funds, they usually mean invest in ETFs that tracks index funds. Alright, let's now talk about some advantages of ETFs. Advantage number 1, diversification. So the main advantage of investing into ETFs is the extra diversification you get. This diversification helps spread the investment risk and reduces the impact of individual stock performance on the overall portfolio. Since there are many companies invested in an ETF, if one company does not perform, you have the rest of the other companies to rely on. For example, VAS is an ETF that tracks the ASX 300, which is the top 300 companies on the Australian stock market. If one of these companies fail to perform, they are kicked out of the ETF and are replaced with a better performing one. And over the long term, investing in index funds for both the Australian and US stock market has performed better than 90% of active fund managers. Now keep in mind, these are people who are highly educated and are paid to handpick stocks, and most of them can't even beat the market. Makes you think, doesn't it? But having said that, we should also remember that past performances does not guarantee future results, but it is an interesting stat. Advantage number 2, low fees. ETFs generally have lower fees compared to other investments like mutual funds, which is an ETF alternative. This is because ETFs are usually passively managed and aim to track a particular index rather than having active fund managers making investment decisions. Lower fees can potentially lead to higher returns over the long term. So in this example, VAS is an ETF that tracks the S&P ASX 300 index, and they only charge a low 0.1% management fee per year. This fee is taken automatically out of the share price, so you don't have to pay anything out of pocket if you choose to invest with them. This is pretty cool if you think about it. For a tiny fee, you get access to a pre-selected portfolio, which gets automatically rebalanced regularly based on the performance of each company. Advantage Disadvantage number 3, liquidity. ETFs trade on stock exchanges like individual stocks, offering high liquidity. If you are a short-term trader, you can buy and sell ETF shares throughout the trading day at market prices. This provides extra flexibility and ease of trading. You can't really do this with a mutual fund. Now on this channel, I encourage long-term investing, so I'm not a big fan of buying in and out of stocks on a regular basis. However, since it's basically a stock, you have the flexibility to transfer them to different online brokers if you ever want to move. Again, you can't really do this with a mutual fund. Now it's not all sunshine and rainbows, so let's now talk about some disadvantages of ETFs. Disadvantage number 1, over-diversification. While diversification can be seen as an advantage, it can also be a disadvantage depending on your risk levels. If you are a risk taker, you may find ETFs to be over-diversified, which limits the potential upside of a stock. If you invest in individual stocks, there is a better chance of a higher return, but also with a higher chance of a loss. Most people invest in ETFs so they can receive the market average return. Since a lot of ETFs just track a large percentage of the entire market, you will generally receive a similar return. This basically means that by investing into ETFs, you accept that you will never outperform the market. Disadvantage number 2, overlap and concentration. Some ETFs may have overlapping holdings or concentration in certain sectors or industries. For example, if you invest in both NDQ and IVV, you will find that a lot of the top companies are the same. That is because NDQ is the top 100 tech companies in the US market and IVV is the top 500 overall companies in the US market. It just so happens that the very top companies are made up of a lot of tech companies, so there is some overlapping. You will also find that many of the top Aussie ETFs track very similar companies. If you want to see an example of this, then check out a previous video I made where I compared 3 popular Aussie ETFs which all invested in very similar companies. And I'll leave a link down below if you want to check out this video. So when investing into ETFs, it's important to review the ETF's holdings and ensure they align with your diversification goals. Disadvantage number 3, limited control. Since ETFs are passively managed, investors have limited control over the individual stocks held within the ETF. Any changes in the underlying index composition or fund rebalancing are determined by the ETF provider. If you want to be an active investor, then you won't get much control investing in an ETF. But then again, if you're a long-term investor, then this could be a good thing. Alright, so as promised, I'm going to show you how to invest in ETFs using one of the best investing strategies to maximize your returns while reducing risk. This is called the dollar cost average strategy. I use this strategy myself and I think it's great for most new investors because it takes the guesswork and emotions out of investing. Dollar cost averaging, or DCA for short, involves regularly investing a fixed amount of money into an investment regardless of its price. The idea is, over the long term, you get the average price of the investment. The main benefit of this strategy is that it reduces market volatility because you end up buying more shares when prices are low and fewer shares when prices are high. This helps to smooth out the effects of short-term market fluctuations. It also makes you a more disciplined investor. Since you are forced to stay consistent no matter the market condition, you become a less emotional investor. If you are constantly trying to time the market, then you will always be stressed when prices are falling, and you may get scared and panic sell, which is the worst thing you can do as a long-term investor. So here are the steps to set up a dollar cost average strategy. Step 1, set your investment amount. Determine the amount of money you are comfortable investing on a regular basis. This could be a weekly, monthly, or quarterly amount that fits within your budget. So for example, you may want to invest $200 on the 1st of every month. Step 2, choose your investment. Select the investment that you want to purchase using the DCA strategy. Before investing into ETFs, make sure you know exactly what you are investing in. Don't just blindly follow what someone says, including me. Please make sure to do your own research first, then select the ETF best suited for you. Step 3, set the investment period. Decide on the time period over which you want to implement this DCA strategy. This could be several months, years, decades, or even longer. On this channel, I'm a big fan of long-term investing, so personally, I'm looking at 20 to 30 years. Please remember, the younger you are, the more time you have to allow your money to compound and grow for you. So if you're in your early 20s, then you have a huge advantage. Step 4, stick to the schedule. Commit to investing the fixed amount at regular intervals, regardless of market conditions or the stock price. This is the key aspect of the DCA strategy, as it allows you to purchase more shares when prices are low and fewer shares when prices are high. So if we fall into a recession where prices are at an all-time low, I know it's very scary, especially for a beginner, but do not give in to your emotions. Stay the course. If you stop at certain times due to market conditions, it defeats the whole purpose of the strategy. Step 5, monitor and reassess. Regularly review your investment performance and make adjustments as necessary. Maybe you get a raise at work so you can afford to invest more money per month. However, it's important to avoid making impulsive changes based on short-term market fluctuations. DCA is designed for long-term investing, and staying disciplined with the strategy is crucial. So overall, dollar cost averaging can be a beneficial strategy for investors seeking to reduce the impact of market volatility and maintain a disciplined approach to investing. It is particularly suitable for long-term investors who prioritize consistency and are not focused on short-term market timing. And for these reasons, I personally believe it's the best strategy for beginners. Alrighty, so you've done some research and you feel you're ready to buy your first ETF. So I'm going to show you exactly how to do this right now. The first thing you'll need is an online broker. Now back in my days, we didn't have many choices of online brokers, and the ones we did have were quite expensive. But luckily for you, we are now living in a golden age of cheap online brokers and many choices to choose from. If you don't know which one to choose, I've recently done a video comparing all the popular online brokers in Australia. So if you want to check that out, I'll leave a link down in the description. But for this video, I'll use Stake, which currently has one of the cheapest brokerage fees on the Australian market. The great thing about Stake Stake is it allows you to invest in both the Australian and US stock market at a reasonable price. To sign up to Stake, you can use the link in my description, which will take you to this promo page. And at the moment, they are offering you a free stock if you sign up for Stake Wall Street, which is the US market, and $10 trading credit if you sign up for Stake Australia. So right now, we just need Stake Australia, but you can also sign up for Wall Street if you want that bonus free stock. The sign up process is about the same, so you may as well. So just click redeem now, then enter your email and make a password. Then they'll send a code to your email and you just verify the code on the screen here. And if you're successful, then it should take you to this screen. And from here, just fill in your details like you're applying for a bank account. They will ask you for some personal information and some proof of ID to make sure that you are who you say you are. It's all pretty simple stuff and you should be able to get through it in a few minutes. Stake usually takes about 1 to 3 business days to approve your account. And once it's ready, you can download the Stake app on your smartphone. For this demonstration, I'll show you how to buy your first ETF on the Stake app, but you can also use the Stake desktop version on your computer if that's what you prefer. The steps are basically the same. But these days, a lot of investors prefer to use the app, so let's open up the Stake app. So conveniently, Stake allows you to enable Face ID, which will save you a lot of time from entering your password every time. So once you're inside the app, the first thing you want to do is make sure this tab at the top is in Australia, since you want to buy an ETF from the ASX. Stake does offer US stocks too, so if you click the tab here, you can switch between Australia and Wall Street. But let's just stay on Australia for now. And if this is your first time using the app, then you'll need to fund your account before you can buy. So let's click account down here and select funds and balances. As you can see, I only have about $2 in my account, but for you, it should be 0. So let's click add funds. Then you can select how much you want to add. Let's put $1,000 for this demonstration. Then click next. Now you have a few deposit methods. You can fund your account using Apple Pay, which is linked to your debit or credit card. You can also fund directly from your debit or credit card. I would strongly not recommend using either of these methods because you have to pay at least a 0.5% fee. And if you need to use a credit card to fund your account, then you probably shouldn't be investing in the first place. The last option is bank transfer, which is the method I would recommend. So let's select bank transfer. The good news is Stake uses OSCO, so the deposit speed should be instant. But I have noticed that even though it says instant, it still takes about 10 to 15 minutes to come through. But that's not too bad. However, if this is your first time, then your bank may hold first-time bank transfers to new payees for 24 hours. But any future transfers after that should be almost instant. Let's click next. And it will take you to this page which contains the transfer details to your account that Stake has made for you. Then you can just use the details here to transfer the money over. Just go to your bank account and transfer the money like you're sending money to a friend or family. Now I've done this in the background, so if we go back to the fund page, I now have $1,000 to invest. So let's go shopping. To buy your first ETF, click search on the bottom here. Then you type in the ETF you want to buy. So for example, if you want to buy some VAS, just enter the ticker symbol VAS. And it should pop up. Just click on it and it'll bring you to this page. As you can see, VAS is currently selling for about $90 per share. Feel free to scroll down and have a look at all the important stats for this ETF. And once you're ready to buy, click this green buy button. Now you're probably wondering why there are so many different prices at the top here and what do they mean. So this green bid price is the amount someone is willing to buy the shares from you. This red ask price is the amount someone is willing to sell the shares to you. Just remember, when you buy and sell shares, there is always someone on the other side that you are buying from or selling to. So there are 2 ways to buy limit or by market order. If you buy with a limit, it means you can set the exact price you want to buy the shares for. For example, let's say we want to buy 10 shares of VAS. Let's enter 10 shares. Then we can set the price to whatever we want. If you want the order to go through instantly, you can set the price as the ask price. So let's do that. Then click review. So now it's showing you this final confirmation page where it tells you how many shares you are buying and at what price. Then it will show you the brokerage fee, which is normally $3 per trade. Mine is currently showing 0 because my account is currently on a special promo where I get free brokerage fees for a year because I transferred my ASX portfolio to Stake from another broker. And if you're interested in receiving the same deal, I'll leave a link down in the description to show you how to do that. But yeah, usually the brokerage is $3, which is one of the cheapest, if not the cheapest brokerage fee in Australia. So moving on, if we are happy with this order, we can click submit and that should go through instantly since we're buying at the ask price. But let's go back a step. Say you don't want to pay the ask price. In fact, you only want to pay $88 per share for VAS. You can do this by setting the price at $88. So let's click review. It'll take you to the same page to confirm your order. Now if you press submit, this order will sit there until it expires in 30 days. Within that time, if the price of VAS falls to $88, then Stake will automatically buy it for you. If it doesn't within 30 days, then the order will be automatically cancelled. Let's go back once again. Let's now try the market order. So click type and choose market order. Now this method is the quickest way to buy your first ETF. You just select how many shares you want and the price will automatically update to the current market price. Let's click review and it'll bring you to this page once again. You can see that the maximum amount here is the max amount that the order will cost. So if you look at the ask price, it's pretty close to that, give or take a few cents. So if you're happy with this, then click submit and the order should go through instantly. And congratulations, you just bought your first ETF. It's that easy. By the way, if you're one of the legends who made it this far into the video, the secret word today is light, so comment that down below so I know who you are. And if you're new around here, consider subscribing to the channel because I'll be making many more personal finance videos like this in the future and you don't want to miss them. So that is how to invest in ETFs. Although ETFs offer many advantages to new investors, we need to remember that with any investment, conducting thorough research and understanding your investment objectives and risk tolerance is key to making informed investment decisions. So if you want to learn more about ETFs and get a better understanding of exactly what you're investing in, then check out this video on screen where I go over some of Australia's most popular ETFs. Thank you for watching, I appreciate you, and I'll see you in the next video.